So welcome, and what a great time this is. This is our week 8, and week 9, I should say. I'm getting mixed up. And welcome to you. If you're still with us, which I suspect you are, because you're actually on this call, I'm very excited about that for you. And this is 49 days into this program. So how good is that? 49 days. And you remember, money doesn't come to chaos. So obviously at this point you would have been cleaning up your mess and getting into action. And I congratulate you. So welcome all the people. Hello, Corinne. Hello. I see all the names coming up. Well done. Today we're going to really cover some important matters, but I do want to firstly, if I can, just quickly do a small review, if I can, just on what we did do on our last session. And if you've got your pad and pen there, we're going to be doing some work on that. You remember we talked about financial fortress. If you remember what financial fortress is, it's at 1 to 2 million in your, let's call it residential property, the places you own or live in. 1 to 2 million in commercial property, 1 to 2 million in your super fund, and $200,000-300,000 worth of income and fully protected. So somewhere between $3 and $6 million in today dollar terms, inflation proof, is the guide that we're working with here as a guide. Now you can have more or less. If you get below this 3 million part, things could be tougher, and most people are. 95% are well below that. So it's a process, and it's not a get rich quick, as you know. It's get wealthy slowly and keep it planned. It's a plan that will have you have choices. So you need to really write that down. And I want to stop here for a moment and just talk about the distinction between basic wealth and cash flow. There's a lot of people in some of the big capital cities in our country that have made some very substantial sums of money in growth, automatically almost, through inflation and the market itself, the Chinese effect and various things. And their properties have gone up, and they certainly may stabilize, and some may even go down. And there are people out there that bought properties 10 years ago for $500,000, $200,000 worth over $1 million now. And that's fantastic. However, you can't eat a house, and you can't live off a house if you live in it. I mean, you can live in it, but if the guttering's falling off, you've got some problems. And unless you sell that house, you have no money. So whereas cash flow is what actually keeps you alive. So a lot of our programs are based on creating cash flow and creating wealth. A lot of people have kind of thought, oh, gee, I've made all this money with my house. I can sit on my laurels. I'm okay. Well, they're still paying rates and taxes. The house is depreciating. In other words, carpets are wearing out. Things are happening. And as I say, you can't live by chewing up pieces of wood or something. In fact, some people burn the furniture in a cold winter's night to keep the fires going. And I know that's a ridiculous statement, but people have done that, pulling up the floorboards. So I want to be really clear with you. My job is to help you create cash flow first, 5 income streams. And we start with one, your job, and then we slowly get rid of that over a period of time. And we add 2 income streams the first year and another income stream each year from then on. So when we talk about financial fortress, it's more of an end result, and it's a journey that we deal with, and the journey is exciting. So got to keep things in perspective. The second thing we talked about was this asset refinancing, tax minimization legally, and we spent a bit of time on that subject. However, it's a very particular area. And in Alchemy One Life, in our One Life company, we have our fully qualified accountants. We've had them, as I said, 26 years now. So they're amazing young men, and you will have a session with them one-on-one if you're one of our Life Magic grads. And we access this accounting practice specifically for our clients and it's really designed for you to help build your wealth and minimize your tax legally. And we talked about some of the 400 tax deductions. Not all of them applicable, but what I would say, usually 10, 20 easy peasy ones, they're ones that most people would be really focusing on. And then the other thing we talked about was looking at your goal card today, and particularly around setting goals and really focusing on your outcome. I think the single most important thing that you'll ever do is to focus on your outcome. That covers a lot of things. That's basically leadership. 90% of leadership is focusing on your outcome. And if you do that, that focus is about intentional living, and it's also really around your goal card, your 7-year plan, all of the strategic spending plans we have, your wealth account. And it's also about your job. It's about what do you want to do and how do you want to do it and when do you want to do it. So you can get all of that. And if you want to talk to us, don't hesitate to send us an email at alchemy@onelife.com.au and we can cover some of this. Tonight on our 9th pillar, our 49th day, and here is loan facilities and how to create them. And I want to spend a little bit of time on that, the 4 treasure troves and how to use them, and building your wealth smartly with a bit of cleverness, 80-20 plan, and the speed of change, and action on using a zero interest credit card. I'd also like to talk a little bit about some of the cards that are available today. Last time I looked, there's a card there, not only zero interest, there's ones at 1.5%. These are kind of holiday cards, short term, can be 3 months, 6 months, a lot of 9 months. There's now ones a year, zero interest, 18 months. They're getting substantial times. I saw one the other day at 2 years. However, there are cards without these holiday periods, if you like, at 9.9%. And that's a great rate. There are cards 11, 15, right up to 19, 21, whatever number you want. It's interesting, they get all the money from the same place, and it's it's under 3% that they're buying the money at, but they're certainly lending them at a very high rate. And of course, there's risk. This is unsecured money. The purpose of a credit card, although we talk about it a lot, is really designed around getting you used to being able to deal with money. If you can't look after a credit card, I've said this before on this program, with $10,000, a couple of them, how are you going to handle a $500,000 loan? How are you going to handle $300,000? How are you going to handle a business that has an overdraft for $100,000? Now, it is interesting how scared people get about credit. In a part of their upbringing, part of their family, whatever, no right or wrong, just outcome. What's the outcome? Scared. And I had a young man in one of our programs just this week, and he's never had a credit card. He's 20 years old. Now, you think, all right, well, it's only a couple of years into it. I also met people at 30 who've never had a credit card. It makes it very difficult for them to assess you and even whether you're capable of paying something back. And although you might think you've got excellent credit, you have no credit because you have never had a history with anybody to see where you're going. And for some of you, this will be a new beginning. You have to go in there and show that you pay your rent on time. You may have need a guarantor to get your first card if you're getting older. You certainly got to show all your pay slips and all the other things. If you're working for yourself, it's very difficult, and some people go through that process and never get a card while they're working for someone else. And when they start their own business, realize that they need some facilities like an overdraft, records for paying bills and things like that for tax purposes. They go and apply, and the bank wants to see 3 years of tax returns before they'll consider that person. And even if they've got a house, it can be difficult. So I'm suggesting that you get with the program and get organized with this. And unfortunately, the rules are very clear. Banks do not lend to people who need money. They lend to people who don't need money. So whilst you don't need it, that's when you need to apply. And the other thing I want to talk about is how to use your super now. So we've got a fairly busy program here tonight. Now, at this point, just to begin with, on 49 days into this, you should have really been cleaning up your mess. And you may have found more mess, like, you know, where's my superannuation? How's my tax return going? What's my credit rating like? Doing the Vita check, getting my important documents together, and having your home office so that you're getting organised. Now, 49 days into this, we would believe that you would be getting that together. Now, there's some squirrels on this call. They've already got all this handled. But I suspect there will be a few people that have to find their insurance policy or their car registration or something that they haven't got, or car insurance for that matter, general insurance, and just rechecking on things. Even things like their phone deal and their power needs and stuff like that. We have a company that it says if we can't save you money on your power, we'll give you $100. Now, that's a pretty good deal. So if you want to write to us and say, I want to check on my phone account and my power and see that I've got a good deal, but particularly with power, just send us in a note, Alchemy at onelife.com.au, and we'll check it for you. We'll have one of our coaches give you a call and get that sorted. And if they can't save you money, they send you $100. Well, that was the last time we looked. It depends how long it takes you to get onto this, but that's the current situation. And we'll see by the time you get around to it. Now, the next part of that then is this part called loan facilities and how to create them. So, as you know, banks are income lenders, not asset lenders. So all of this is about serviceability. It's about lending. I want to give you a couple of formulas if you'd like to write it down. The last time I looked, and it changes all the time, banks will use, say, as an example, a serviceability of a debt. And they use two basic formulas, whatever the debt is. For instance, say you're buying a house, or say you're buying a car, or say you're buying a commercial property, or anything at all. They would say, let's see how your serviceability is. First thing they'll look at is an interest rate they'll choose, and they'll choose whatever's current. They use a 7% rate as an example. And it could be lower, it could be higher, but whatever they... And if they feel the rates are going higher, they'll put a higher rate in there. If they feel the rates are falling or they're going to stabilise, they'll put fairly well current amounts in there. But let's just use this example, 7%. Let's say it's $100,000, just to pick a number. 7% of $100,000 is only $7,000. It's not a lot of money. So they're looking for you to be able to service $7,000 up above all your other expenses, and they use a 1.5 times calculator. What does that mean? A 1.5. They do it half a times again. So they'll take that 7,000 and call it 10,500. In other words, they'll divide by 2. 7 into 2 is 3.5. Add it together, and that makes 10.5 or $10,500. What it really means is 10.5% if the rate's 7. What does that mean? That means 150% serviceability. In other words, they're using a bit of a margin to see that you can afford this. And they'll use that margin, say it's a housing loan, they'll use a margin like that at about 30% of your income total. These are just very rough guides. So if you're on $100,000, just to pick a number, they will take 30% of that serviceability. They'll call that $30,000. Because they'll say that you have to eat and pay for cars and various other things, and they'll check all your expenses too, and any other credit cards and other things you have. And they'll say, okay, that $30,000, and they'll say, we will deal with a 1.5% serviceability, so, or 1.5%, which is really 20,000 serviceability, and on a 7% amount, that's like, you know, roughly bit under $300,000. So That's to give you a guide. Now, a trick in this whole story, and you can go online and find serviceability and go to almost any bank, and they'll show you online confidentially. You don't have to even put your name down, and you can go on a calculator, and it will work out that number for you. So you can see serviceability on a property, a residential. On a commercial property, because the yield is so high, 7% yield, as an example, 10% yield, 5% yield, I don't buy properties under 7%. So 7% on $1 million property is showing me net $70,000. So if I'm borrowing at 7%, they actually, on 100% funding, it would actually service itself to the exact same number. If I put down $200,000, I'm actually positively geared on that transaction immediately. Now, that might not be understood by everybody. So let's just work out a couple of jargon terms there. What does positive geared mean? Well, positive gear means that if you buy something for $1 million and the rental income that's coming in is $70,000 and your mortgage payment, including all outgoings, is only $50,000, then you're positively geared by $20,000. In other words, your expense is $50,000, your income $70,000, therefore you're $20,000 cash flow positive. Now, in a residential, it doesn't work that way. Usually a residential, when you borrow money at with an 80% loan, you're usually negatively geared. What that means is that you might get a rental on a $500,000 property for $500 a week, less rates, taxes, and all the rest. So you end up about 3.5%. You end up about something in the order of $17,000, say, something in that vicinity per year. And your payments on the loan could be $25,000 as an example. So you're negatively geared by about $7,500, and sometimes it's 10 because the tenant didn't pay, or you had 2 weeks worth of costs from the agent to get the tenant, and had some rates and taxes that time, or some repairs or whatever. So $7,500, $10,000 loss per year, which is claimable on your tax, however expensive tax deduction, and it's called negatively geared. Whereas the first example, positive geared, positive income, negative geared, negative income. In the positive geared, you get that as income. Of course, that's taxable in your hands, which is great because our main goal here is to create income streams that you don't work for, that the properties work for, that the business work for, other things work for that you don't. And 5 forms of these incomes means that you've replaced your job. So in neutral gearing, as it covers itself, neutral gearing means that the rental and the income are identical. In other words, pretty close to neutral. So you've got a $20,000 income as an example, and you're getting $20,000 worth of expenses. Some people achieve neutral gearing on a residential by just putting more cash in, and we call it discounting your capital base. What that means is you've just bought more equity, more cash in the property. So if you take a $500,000 home unit or house or something, and you put in $300,000 of your own money and only borrowed $200,000, then that $200,000 may be $15,000 a year or something in that order, and the income may be that $17,000. So you're a couple of thousand ahead, or neutrally geared, or something like that. And the only way you've been able to achieve that neutral or positively geared situation is because you put so much cash in. And people discount their cash. They forget about the cost of the $300,000. That was the capital that you put in, plus the legal cost, stamp duty, and so forth, and just borrowed the $200,000. Looks good on paper, but that's not true. And why I say that is that the $300,000 is worth money, and that $300,000 in my mind is worth at least 10% return. In our Prodium transactions, we pay 10% on interest plus 20% profit or loss, but generally it's profit. So minimum sort of 10% the way we look at it. So 10% on 300,000 cash in the transaction is worth $30,000. Now, if the property's going up by $30,000, then you'd break even on that deal. And sometimes that's happened. When you're in an overpriced real estate market or a falling market, that doesn't happen. So you're really in not good times. And I'm really of the belief that residential property does not increase by 10% per year. On average, it doesn't. If you got inflation plus, you'd be doing well, plus the rental return. So the rental return net's about 3.5. The inflation say total 6.5, counting rates, taxes, capital gain and income. Whereas a commercial property would have usually about a 7% net income, so that's basically double the residential, and would have a much longer tenant, a 5-year tenant with a 5-year lease, maybe option, so 10-year, 20-year leases. But the most important thing is the escalation clause inbuilt in the rent. In other words, the rent goes up every year, every 2 years. And it can go up by 3%, 4%, 5%. And that's adding enormous value to the property. Not only is it adding value in income, but that income is being demonstrated. It's called yield, and that yield is increasing the value of the property. So investing in real estate, there's different classes to invest in, different risk equations. I personally think that commercial property is safer than residential. That's just my opinion, particularly when I'm looking at an overpriced residential market and I look at the lower yield. I'm a very specific investor for this. I trade residentials. I buy low, sell high. I don't hold that much residential anymore. I used to back in the 90s when inflation was running riot and you couldn't really go wrong. But I've moved more into commercial property because of the higher yield, higher rental. So cash flow is everything to me. And I get the growth as well. Plus I get longer tenants and less challenges. I never have them ringing me up and wanting to fix their tap because it's leaking because they put the tap in. I never really spend much time on that kind of maintenance. So maybe that gives us a little bit of an idea. Now, creating loan facilities around that, as you get higher growth in your property, you can refinance or remortgage your property. And I explain this way, that most people only know there's 2 ways of having money. One is that you sell the property or you keep it. There's only 2 ways, but I actually think the third way, that refinancing, you're able to take some of that equity, some of that growth out of the property. So you bought a property for $500,000. It's now worth $800,000. Originally had a $400,000 mortgage on the $500,000 property. If you want to write these numbers down, you can, or play this again, which would be an 80% loan. Property's now worth $800,000. 80% loan on an $800,000 property. 160,000 is 20%, so it must be 640,000. I'm doing this in my head. So 640. You've got an original loan at 400, so it's now an extra 240,000 you've redrawn, or extra money you can get, taking some of that equity. And that can buy another transaction. It can fund a renovation on a property, can buy a block of land, you can flick that land. All these things we cover in depth in Life Magic in much more detail than these kind of calls. And with our mentoring programs, we show people how to really build that ongoing and deal with some of the challenges that come up, because we're having those every 2 weeks on a Thursday night. So lots of different opportunities there in quantum property and information, particularly guidance around this area, because a lot of agents will, be obviously pretty keen to sell a property to you. We don't sell properties to our clients, but what we do show them is how to buy them, how to buy smartly, how to buy wisely, how to buy under the market. Next week, I'm going to talk about some of the principles and strategies we use. So you'll like that on our 10th pillar, our 10th week, and we'll be looking at that. So I hope that's kind of helpful for you. And if you've got any questions, you can always send me a line at alchemy@onelife.com.au. and we can answer those questions for you. Now, I want to move on to the 4 treasure troves. Now, what's this? This is like how you see yourself and where you are in the game of building your wealth. The first treasure trove, we call it security. It's just, imagine that you can draw. In fact, if you do this now on your books or paper, whatever you're doing, it's good to put in a book, because these notes you want to reflect on and review. Wisdom is a very important thing, and it's not just experience and knowledge that most people think wisdom is. It is experience and knowledge. How it is reflection. Reflection gives you wisdom, and when you reflect on your notes, you'll get wiser. So if you draw a little box and call it your security box, draw 4 boxes, and each one of these is a treasure trove and your treasure box. So imagine there's gold and money and a whole lot of stuff in there, like the pirates have. So the first one's security. And what is security? That's just your cash, if you like, your support. And I maintain 3 months you need, kind of as a minimum. And we call that security. Now, when I'm in my Life Magic program, I ask people, how much do you need? And ask a young boy and a young girl, and a teenager, or maybe a kid at school or something, 14-year-old, and they go, oh, $100? They think that's a lot of money. Ask a teenager, they say, oh, gee, $500, and some would even say $1,000. I have a client that needs $20 million in his security box. In other words, it's all related to your turnover. Average family, I would say probably close to $20,000 that need in redraw facilities or security. Could be more, depends on their income. If you imagine that a family's doing a couple $100,000 in income, that could be in the order of $50,000, could be in the order of 60,000, could be in the order of 40. Whatever your spending is, because it's not just your income, it's what you spend. And some people earn 100,000 between them and they spend it all. So that would be a third of that, or a quarter of that, which would be $25,000 to $30,000. Now, here's a trick. If you have your money in cash, you don't earn very much. It's good to have some cash, and usually $4,000 or $5,000 would handle most immediate things on any week or month. However, a thing that you can do is to have a credit card that you put in the freezer, and it could be a $10,000 credit card. So by having that $10,000 credit card, you don't have to have the cash in the bank, which the bank loves to have, because they pay you a very low rate and lend it out very high, and might give you 3% interest and lend it out 20%. So it's a pretty good deal. And that's why credit cards are so important, because they can be used as a, if you like, what if situation, a what if scenario. And it's just getting clever about money. It's like an overdraft we use in a business. So this way you get your money working. Now, if you don't know how to get your money working, then just put it in the bank and that's all. But this program is really around, what are you going to do with your money? What are you going to do with your life? What are you going to do with your time? How are you going to do this? So in the Life Magic program, we spend a lot of time on getting the maximum usage of money. And if you can get a 10% yield on your money, why would you leave it in the bank and get 3? Why not get it to work for you and have a credit card standing by for the same amount of money that you don't use, so that if something comes up, the car blows up, I've got to get on a plane because someone's died overseas or something. Usually $5,000, $10,000 handles pretty well most issues. So by putting that card in the freezer, you've got that standing by, but you've got your money working, if you understand the strategy there. Irrespective, either buy credit card or redraw facilities on your home. If you've got a home, if you don't have a home, credit card. Redraw facility, all that is a mortgage on your property that you haven't fully drawn down. So you might have a $500,000 house, a $400,000 mortgage, but you've only drawn 300. So you've got 400. You've got another 100,000 you haven't drawn. And having that redraw can have your money working better. So I always have redraw facilities available, and that way I'm always utilising my cash, my money, as much as possible. So cash is king, and but I need my reserves. So that's the first treasure trove. The second one, and this can be a little confusing because it's a question of order. So I'm going to start with a person who doesn't have a lot of money, a lot of assets. And the second one, we call it trading treasure trove, or momentum trading treasure trove. What does that mean? It means a small amount of cash that we trade to make money. Because the third treasure trove is your buy and hold treasure trove. That's the one that you've bought property and you're holding it, commercial, residential, or it's a portfolio of shares. You bought them and you're holding them. Whereas if you don't have those kind of assets, you tend to use your trading to build those assets. And as One Life is very much to show you both of those formulas, not that one's better than the other, but in different market times, we believe it's important. And right now, we're really working a lot on that trading area. So we'll buy a property under the market, or we'll take control of a property under the market through an option or a terms contract, or a whole range of different ways. We have a 47-step plan on that in our Life Magic program. We use $1,000 and we can take control of a property worth $500,000. Now, our intention is to make $25,000, $50,000 out of that transaction. In Life Magic, I show a transaction with using $1,000 to make $300,000. It's a much more complex one. It has a small subdivision in it, a block of land that we put a subdivision on, and we use $1,000 and sell 2 blocks of land, a house on one and a house and land package on the other. So we don't pay stamp duty. We don't pay. We don't have mortgage costs. We do it in a very different way, a different mindset. But that's another story. But what trading is about is using a small amount of money and taking charge of a property. A very simple way is to take an option on a property that you're renting, do it up and sell the option. That's another process. So this small amount of money can make money. It can make $25,000, $50,000. It can make substantial sums. I had a client use a credit card and use a $10,000 credit card use $9,700 doing the renovation, and sold it for $27,000 profit, including the payment back of the $9,700, and got a tax deduction for the interest on the $9,700 as well. So a relatively small amount of money, $1,000 of his own, a credit card which, if he got all the money back from, and virtually paid very minimal interest because the whole deal was done in about 6 months. And so the yield to make $27,000 is massive, massive yield. So that's where your trading can build wealth. And if you did that 1 or 2 or 3 times a year, you start to make some money. Our goal is to get everyone to do 1 real estate transaction in the first year, 2 in the second, and 3 in the third, and just keep on going. As you know, Kate does one every couple of weeks. In fact, I think this year he was doing 1 a week at one stage. So I mean, obviously that's a fabulous result. And Harry had done 1 a month for the first year. I remember that 12 transaction he did, made $1 million. So that's not what you're going to do. However, if you just look at it on the basis of trading, that's your trading, your momentum trading. You can trade shares the same way. You can trade businesses. I had a guy who was buying it was a hairdressing salons, that's right. And buying them very cheaply. One I think he bought for $20,000, another one for $15,000. The young lady had put a lot of money into it, gone bust, and didn't know what she was doing, and was a great hairdresser, just not very good at running a business as a hairdresser. And he used to get his girlfriend or one of his friends in there, and build the team back and then put it back on the market and sell for 25 or 50,000 or whatever he could sell them for. So he was trading businesses. We had a young lady, Mona. Last time I checked when she was young, I think she was 18, 19 years old. Before she was 20, she had done something like about 17 cars. And she was buying these cars for 2,000, 3,000 and selling for 6,000, doing them up and placing them and doing them well. And what we really taught her to do was to move an extra naught on the end of that and trade properties, because it was the same process, just a bigger number. Instead of a $2,000-3,000 was a $200,000-300,000 deal. Instead of selling for 5 and 6, you're selling for 500,000-600,000. So that's what trading is. And so that trading process, you only need a small amount of money, and then you what we call take off the top, skim that, and we put that into buy and hold. So we trade, but we can't take those profits and put them into buy and hold. I would personally get you to look at seriously commercial properties if you want to do a buy and hold situation. Obviously, you can look at businesses, buy and hold those, and you can always sell them later. But there are some tax advantages for buy and hold in those areas. So come back and we get back to this. First, treasury trove is your security one. Second one, your trading, your momentum trading. Your third one is your buy and hold. And your fourth one is known as your freedom treasure trove. Now, freedom is when you want to have a really good holiday, or you want to buy a boat, or in my case, I bought a helicopter with my freedom one. Or look, you can buy an island, you can buy a farm, you can do whatever you want. And the way I like that one to look at, it's a long-term deal, is that out of all the money after you've got your security and you've got your trading and you've got your buy and hold, 10% goes into your absolute freedom treasure trove, which is just fun, things that you want. It's in your bucket list. So that's what you're doing there. I hope that makes sense. It's in a long-term plan to get clarity, and clarity always leads to power, and power is always in the present. And when you're in the present thinking about this and then using this as your future plan and focusing on that, you're not focusing on what you don't want. You start focusing on what you do want. Talking about that, in this day today, we talked about the 80-20. And you've heard me speak on this before. So 80% of a carpet will be fine, but 20% will be worn out, and that 20% at the entrance and different corridors and so forth will mean that the carpet gets thrown out. 80-20 rule applies on a lot of things. 80% of your income is earned by 20% of your activity, and 20% of your activity earns 80%. So obviously you want more of that 20% activity that's earning 80%. And if you may recall, we talked about putting the big rocks in first, putting those rocks of the things that are important to you, your health, your well-being, your family, your career, your business, your spiritual life, exercise, things such as intellectual, social, whatever the things are, the big rocks, your children, whatever they are, go in first. And then those little fillers fill up the space. And the interesting thing is when you put those big rocks in, those fillers overflow eventually because they are just fillers, and you eliminate them. And the famous Stephen Covey always talked about, instead of a to-do list, make it about relationships. If you look at those big rocks, they're all relationships. Relationships of your family, relationship with your health, relationship with your money, relationship with your team, relationship with your businesses. These are all relationships. Even intellectuals are a relationship, your spiritual relationship. Everything about you is a relationship. Even your time you spend with yourself is a relationship. And some people don't like themselves that much. But learn to love yourself. Learn to create relationships. And they're all those rocks are relationships. Speed of change takes a heartbeat. That's all it takes with a decision. With the decision in a heartbeat, your life can change. And then you put in your 4 quarters. First quarter, first 90 days, and we're more than halfway through that, clean up the mess. Second quarter, second 90 days, all action. Now, usually in that first quarter, you're not only cleaning up the mess, but you are taking some action. And next pillar, we'll be talking about some of your action steps as part of our strategic work we're going to do. So speed of change, heartbeat with the decision, and then you process it. There is a delay. The delay is about 90 days. I call it that delay time, that period where things have to catch up. It's like, I'm going to advertise and do something. I'm going to put something on Facebook. I'm going to sell the thing in Gumtree. I've got to take my photo. I've got to put it on. Got to wait. There's this catch-up period. And then when I get it sold, it takes time to get the money, and the money has to get in the bank. I have to deliver the product or the service or the good or the application. So these are the delays. And everything takes about 90 days. So, and some take 30 days, and some are more instantaneous, and some take longer. If you've got a 5-year plan, obviously it's going to have a 5-year delay. But that's made up of 5 years of 4 90-day plans, if you really work it out. So that's how it is. And just to talk a little bit about those interest rates as I finished tonight's session off, I was talking about zero interest. Pretty well all the banks every month advertise zero interest or low interest. Just go online, you'll see them. You need a good story, and then you want to go to the bank and always go face to face to the person, and never just do it online. Don't go on a zero interest unless you're a very strong borrower and you've got a great credit history. When I say a strong borrower, you've got property with a lot of equity, you've got a large income, your income is servicing that, you've got your tax handled, you've got no bad credit, you've got other assets, you don't have many credit cards, you're known as a good person, and even then I would go in and talk to them. But it's really interesting. People go online, got a job, but don't have any assets, and the job might be taxi driving or Uber driving or something, spending most of the money they have. And if the bank wants you, they'll give it to you. If they don't, they don't. Whereas you go and see the person face to face, have a talk to them, and tell them you're going to bring your super fund there and other things in time. Have a story about that you're going to start your home office, if that's true for you, or whatever you're going to do, and that you're wanting to buy a new computer and a new desk and a shredder and a printer and a pile of stuff, and you can make more income this way because you're going to do bookkeeping or something, then they're going to look at you in a very favourable light. And even if you don't have an asset, if you can show that and if you don't own a property then, and you just can show them that you're on time on your rental and you've got some good references, they will give you that start, that credit card or an extra one. Or if you've got one, they'll take over one. And that's what you once call a balance transfer. Each bank calls it different things. If you've got a $5,000-$10,000 card and you can get a balance transfer $5,000-$10,000, and they'll give you a zero interest for a year or 6 months or 18 months, and then you've now got your card freshly, nothing on it. It's fully paid, and you've now got a card that you can do an option on property and renovate that property and make some money. Now, there's risks, and you've got to be careful that you can service this debt and so forth. But this is how you slowly get out of that rat race, how you use other people's money, other people's time to start building your wealth. A quick story I'll tell you next week about credit cards, that when you're doing, there's a little trap that I want to show you on when you do a balance transfer. So I'll cover that next week because I'm nearly out of time here. But I will talk about that, as I will talk about some principles and some strategies and tactical areas. So I think that's enough for today, or tonight. I'm mindful of time. I want to just remind you about your strategic work, your homework. We call it strategic work. Your gold card and your blue form, your strategic spending plan that you can get from our program of abundance. And you can go on onelife.com.au backslash, what was it, forward slash from where I'm sitting, forward slash from where you're sitting, abundance. And you can get that package, and you'll see in there all of the DVDs and all the thumb drives for that program to create your strategic spending and to live from real gratitude. And in there's also the 180-day plan to create your home office and important documents. And that's something that I'd like you to do, is really get those important documents, and particularly a superannuation, and particularly how to know where you stand. And so if we have a week there, I was going to talk a little bit about super now. And basically what that means is you can actually activate your superannuation fund and get control of it. I will do that next week, and we'll start there with superannuation. I'm also going to do a review with you and start your action plan, and also choosing your vehicle, and really setting up some clever things around using your assets to build towards your financial fortress, and really being on purpose and being on course. So it's going to be an exciting next week, next pillar, and do your strategic work. And until next time, may you be with grace, and may you live an abundant life. Thanks for coming on, and we'll see you next week.